In the name of God, the most merciful, the most beneficent, and in this part of this lecture, we are going to cover strategic financial management, chapter B, corporate finance, under which, and we are going to study under long-term financial management section, that derivatives. And under derivatives, we are going to cover about options in this part of this lecture. And then next will be about forward and future contracts. Learning outcome. So we will be able to define and demonstrate an understanding of derivatives and their uses. Long position from short position, we will distinguish and define options and distinguish between a call and put by call option and put option by identifying the characteristics of each, and define exercise price, strike price, option premium, and intrinsic value of these derivatives. Stop. So what is derivatives? A derivative is a contract between two or more parties whose value is based on an agreed upon underlying financial asset. Or it can be a financial asset, or it can be based on an index or on security. So we have stocks, bonds, commodities, currencies, interest rates, market indices. Based on that, we can have a derivative. These are the underlying things. So futures contracts, forward contracts, options, swaps, and warrants are commonly used derivatives that we will be studying in detail. And derivatives are used to either mitigate risk, that is by hedging, or assume risk with speculation, and we will be studying. So derivative is a financial instrument whose characteristics and value are derived from the underlying price or value of some other more basic financial instrument. It can be one of the financial instrument that we are discussing here. It can be a stock, bonds, commodities or currencies, interest rates or market indices. The underlying assets, it can be called as underlying. Could be equity, bond, a commodity, currency, investment, and market index. In the Accounting Standards Codification, topic 815, which talks about derivatives and hedging, it requires a derivative to be recorded on the balance sheet as an asset or liability based on that, whether you buy or sell, and to be measured at fair value. The Accounting Standards Codification, topic 815, notes the following points. It includes one or more underlying assets and has one or more notional amounts or payment provisions or both. It requires no initial net investment, or it has a smaller investment than other types of contracts that would be expected to have a similar response to changes to market factors. The net settlement, that means the contract payment, must be a cash payment, or it can be a delivery or an asset that can be easily converted cash or another derivative. Changes in fair value each period are reported in earnings unless the derivative is designated in a qualifying hedge relationship. So if there is a hedge relationship, there will be a compensating item, a financial instrument derived for that with an underlying. So that will be managed accordingly. So all these three characteristics must be present to meet the definition of a derivative according to Accounting Standard Coding under topic 815, which provides on the derivatives. So the underlying asset or anything can be a notional one or payment provision, or it can be both, and no initial investment is required, or it can be smaller initial investment, and instead of providing the 100% value, it can be 10% or 5%, like that, a smaller initial investment than otherwise required to obtain same exposures. So when you have like call option, put option, you don't need to have the full investment required on that. And net settlement should be there, or it should be equivalent of net settlement, something like that. All three characteristics must be present to meet the definition of a derivative. So, a derivative involves a contract between two parties. We know that. Payment is exchanged between the two parties. The amount of the payment can be either a predetermined amount triggered by a specific event, example the price of the underlying asset exceeding some minimum value, or the amount resulting from the change in value of a specified quantity of the underlying is referred to as the notional amount. See, for example, referring to a particular financial instrument, whatever the price index change and that change, like that, it can be referred like that. It's a notional conceptual amount or the face amount of the contract. It can be. Corporations do not use derivative to raise money but buy or sell them to protect against adverse changes in market factors. So like this is called hedging. They don't want to do for investment purpose, and it is for hedging purpose to cover the risk. Hedging is a tool used by individual investors and companies to manage the risk. When a company has a transaction or investment position that exposes it to some type of risk, a hedge may be created to reduce or eliminate that risk particularly. For example, if after 2 months, if they have to pay in British pound, if your company, they may involve in foreign currency hedging, so that taking a call option and all, which we'll be studying in detail in this part of this lecture. So that is called hedging. So it is only to done for covering the risk. So derivatives are complex financial instruments which may be risky. Conceptually, there are two basic types of derivatives, that is options and forward contracts. Other derivative instruments such as futures and swaps or some combination or variation of options and forwards that we will be studying in detail. The use of derivatives to either hedge or speculate results in offsetting risk when hedging and increased risk when speculating. So what is the meaning of hedge or speculation? Hedging is the process of using offsetting commitments to minimize or avoid the impact of adverse price movements. If you know that there is a price fluctuation, so we involve in hedging so that to offset that, to cover the risk. Speculation is purely like involving the assumptions of risk in the hope of gaining from price movements. Okay, this price will increase, so let us buy this thing and keep it, and then when it is increasing, we sell it and we cover. That is purely speculative, not hedging. So that is the thing here that we should understand. A hedge is an offsetting transaction to cover the risk, so that if the original transaction causes an adverse outcome, the hedge will create a positive outcome to cancel it out. And of course, if the original transaction causes a positive outcome, the hedge will also create a negative outcome that will cancel it out. So the net will be that fair same amount, not very minimum cost will be affected due to this hedging, the cost of that hedging. Okay, that's it. The purpose of a hedge is not to guarantee a positive outcome, but to reduce or eliminate the risk. If it happens, if worst situation happens, this hedging will offset it. That is the main purpose of it. Speculation involves the assumption of risk in the hope of gaining from price movements, whereas hedging is the process of using offsetting commitments to minimize or avoid the impact of adverse price movements. So derivatives. Specifically, now we are going to talk about options. What is the meaning of options? An option is contract between two parties wherein the purchaser of the contract, that is the option, has the right but not the obligation. That is very important. He can opt to buy, but not necessarily not obligated to buy. That is the important point. He can take that option to buy in future of one particular underlying asset, that is called option, but he is not obligated. It is not obligatory for him that he must buy. Okay, and it is not obligatory for him to sell if he has taken a put option. Okay, given amount of given this amount of an underlying asset. So the objectives of these option trades are as varied as there are option strategies. Options can be used to take positions that are extremely bullish. Bullish means raising market, raising share prices, uptrend in the stock market. Extremely bearish, that is downtrend or anywhere in between. Options typically are used for leverage or protection, leveraging to control the risk, okay? As it can be used to limit the risk, or it can be hedging against loss or speculative also. Options offer protection by guarding against price fluctuations until the maturity date. So until the maturity date, the fluctuations will be there. So if you have the option, so you can deal with that so that you can be safer on that side. This limits the risk of forfeiture of the option premium unless the underlying is not already down. So if the underlying asset value is already owned, so maybe you are not affected by the uh, option these things. Okay. For example, if you have a call option, so buying option, and you have to buy, but if the price is high, you will take that option because it is good for you. If the price is below the market, you don't need to buy. Supposing if you have a put option to sell, that if the price is already that you have an option, and if the price is down, okay, you will be anyway willing to sell it because it's an option for you because its price is market price is down, but you had already the put option which is good for you, so you will be selling it. So that way it is that, okay, kind of benefit. But whereas if you have an option that you will be opting to provide that particular asset, and if that option is exercised, you have to give that. So that time, if you have an underlying asset already owned by you, you can take that choice. Now let us understand certain key characteristics of certain terms involved. The party with the option to buy or sell is the owner of the option, also called the buyer or holder of the option. That means an option can be buy option or sell option, that means call option or put option. But still, if you are buying that option, you are the buyer of that option. And the seller is the writer or can be the seller of the option. Underlying asset may be a tangible or intangible. Tangible such as stock or commodity or currency. Intangible can be a consumer price index or LIBOR like market interest rate, prevailing interest rate. Transaction types, as I said earlier, also in options, call option and put option. Call option is an option which gives the right to buy, not obligatory to buy. The right to buy the underlying at a specific price on or before a specific date. That is the last date, specific date that he can exercise that option. That is the right, but not obligatory to exercise. If he is not profitable to exercise that, so he can keep quiet. That's it. Only he lose the buying cost only, the purchasing the option, whatever the margin, whatever the cost he paid, only that cost is lost. Similarly, put option is also it's an option which gives the right to sell the underlying asset at a specific price on or before specific date, but not obligatory to sell. So the key characteristics involved in these options. So we have strike price, exercise date, and premium, margin, and writer, buyer. So writer means seller and buyer means owner of this option. That is the key terms, how it is defined that we are seeing in this slide. So strike price, or it can be called as exercise price, refers to the fixed price of the contract. That means if the buyer of that option exercising that, and what will be that price, that is the option price. That is called the strike price, or it can be exercise price. The exercise date, it will be also known as the maturity date, or within that date it has to be exercised, or expiration date is the last day on which the buyer, whoever want to exercise buy option or sell option that of that underlying asset can do that, not after that. Buying option requires premium to be paid and selling option requires margin to be paid. So If you are buying an option, you require some premium you have to pay as a cost for that, because you are getting, maybe you will be getting a good margin profit on that, so you pay better price. And selling option also some margin you have to be paid, because for that, because you have a selling option, you take that margin, profit margin for that. The premium is the initial purchase price of the option. It is usually stated on a per unit basis. For each unit, that this is the price, the face value or the premium. The seller of that option is called the writer of an option. He receives, the contract receives an upfront premium from the buyer. From the buyer, you get a premium. The owner of the option, I mean the buyer of the option, that is the contract. This premium obligates the writer to fulfill the contract to sell or buy the underlying asset if the buyer chooses to exercise the option. If the buyer of that option chooses to exercise at the strike price at the exercise date, the seller, the writer, must sell it. So that is the important point. So for that purpose only he is taking some premium. So some more key terms. The asset which is bought or sold is called underlying assets, that we have already seen. It can be a stock, bonds, or a commodity, currency, or intangible assets like LIBOR rate and things like that. Okay? Consumer price index, etc. American options, European options. These are the two terms. Most of the examination they ask about this question in one of the multiple choice questions. So students must be careful and understand the difference between these two. Simple. American options can be exercised anytime on or before the expiration date. It can be exercised anytime before that expiration date. Binomial option pricing methodology is mainly used to price American option. Okay. European option can only be exercised on the expiry date of that contract, only on that particular date. So Black and Scholes methodology is used to price European options. So the difference is that American option can be exercised anytime before that exercise expiration date, on that date or before. European option only on that particular date it can be exercised. That's a key difference. All index option is European trade options in India, and they can't be exercised in between, but they can be sold anytime. All stock options are American options, and they can be sold or exercised anytime. So European options can be sold anytime, but can be exercised only on that particular date. So that is the. So here we are seeing comparing the derivatives with the various options like call option and put options, and using the payoff structure, the return and risk reward return structure. That is the thing. For example, the condition, an option, if it is equal to strike price, it is called at the money. If an option is equal to the strike price, it is called at the money. That is in short form, it is ATM, at the money. If an option requires a payment to the owner, if the contract is exercised immediately, it is in the money. It is ITM. If there is no incentive for the holder to exercise the option, that means it's not profitable, no incentive, so it is out of the money, OTM. So this is the three things that you should understand, whether it is at the money or in the money or out of the money. So that's an option. This is the top that the dealers are talking also, and management accountant should be aware of these things. And a call option, if strike price is greater than the price of the underlying asset, if strike price is greater than the price of the underlying asset, it is out of the money, means no use of exercising that price, because the underlying asset is lower than what you have strike price. So better not to use that option. So that is why it is out of the money. If the strike price is less than the price of the underlying asset, it is very good. Market asset value is greater. So you have an option already. We can exercise that. So it is in the money. So that is the idea of taking. Similarly, for the put option, if the strike price is greater than the price of the underlying asset, so nobody will lose that choice. It is in the money. So that because the strike price is better, already you have an option price is better than what is in the market. So it is in the money. If the option is less than the price of the underlying asset, so it is out of the money. So you need not exercise that option. Let's see an example for call option. So in the call option, owner is the buyer of the option to buy. Okay, a 30-day option contract is made between a buyer and a seller for a commodity. The strike price is $50 per unit. The premium is that premium he paid is $2 per unit. Two scenarios are possible at maturity. That is, the strike plus premium we should keep in mind for the buyer of that option. The cost is about $52 because the strike price is 50 and he already paid premium, so it is 52. So if the market price is less than the strike price plus the premium, okay, the owner would not exercise the option and would lose $2 for the option premium. So he will do this. Okay, but maybe we can think of that if the at least if the market price is like 51, maybe he will use it because his cost is 52, but at least he lose only $1. That is the idea that you can calculate that way. Okay, but generally speaking, the strike price plus premium, if the market price is less than, you would not exercise that option. And if the market price is greater than the strike price plus premium, the owner would exercise that option and make a profit because he gets the profit. Because market price is good, so he has already a call option price which is cheaper for you. So that he will exercise that. The owner would not exercise the option because he could buy the commodity, the underlying asset at the current market price in this case. Okay. In this case, the owner would not exercise that because he can buy it from the current market because the current market price is cheaper than what he has as an option price. Okay, only the owner will lose $2 for the option premium. Okay, unless, as I said earlier, if the market price is equal to the strike price and he could also cover the little from the premium amount, so he can use it. Okay. In this example, we are seeing the put option. That means the buyer is the owner of that selling option. A 60-day option contract is made between a buyer and a seller for a commodity. The strike price is $30 per unit. The premium is $1 per unit. So you have this strike price mean 30 plus 1, $31. So keep that in mind. If the market price is greater than the strike price premium, the owner would not exercise that sell option because market price is higher. So he can sell in the market instead of exercising this option. So that is the idea of that. He will only lose that $1 he paid as a premium. And if the market price is less than the strike price, he will sell it. That's the idea of this. The owner would not exercise the option because they could make more money by selling the commodity at the current market value in this case. Okay. So some more details about the options. And options can be covered or uncovered. That is covered option or uncovered option. Uncovered options usually called as naked option. So a covered option is one in which the seller, that means the writer, already has possession of the underlying. Suppose the owner is selling that option, he has in his custody, in his possession, the underlying asset already. It is called covered option. If he is not having it, he may buy also if that option or pay the penalty for that. So that is the naked option. Actually, naked option is a speculative instrument. Since the writer does not hold the underlying without having anything, கையில எதுவுமே இல்லாம விக்கிறது. Okay, that is the idea. வெறுங்கையை வச்சு மழை போடுறது மாதிரி speculative option. He may have to acquire it an unknown price in the future to satisfy his or her obligations under the option contract. This type of option does not have the backing of stock. So that is naked option. So these are the difference. Options can be classified by their underlying assets also. Either it is a stock option or based on an index, or whether it is a long-term equity anticipation securities. So that is short form is LEAPS, that is long-term equity anticipation securities. They are examples of that long-term options. And they have usually expiration dates up to 3 years away. Foreign currency options give the holder the right to buy a specific foreign currency at a designated exchange rate. At the time an option contract is set, neither party is required to own the underlying asset. When the contract is set, they don't need to have the underlying asset on hand. In an option involving shares of stock, for example, the writer of the option does not have to currently own the shares of stock. However, if the owner exercises the call option, that means the buyer exercises the call option, the writer or the seller of that stock, he must deliver the stock. That is, if he does not own already, he need to buy whatever the price in the open market and deliver it to the option owner. That's the thing. If the current market price exceeded the strike price, the writer will get only the strike price. So the buyer of the option will pay only whatever the strike price agreed, but still the writer, the seller must buy from the stock from the market whatever the price, and he should buy it and sell it. The buyer's gain, or it can be loss, necessarily mirrors the seller's loss. If buyer is gaining, seller is losing, and vice versa. The amount of gain and loss on a call option can be calculated as follows. Suppose buyer, the holder of that option, that is called long position. The seller or the writer is in short position. So this is one technical term that is used here. That means unit of underlying that financial instrument multiplied by the excess of market price over the exercise price. That is the option price. So whatever the excess of market price over the exercise price minus the option price. Or for the short option, it is the units of number of units of that underlying asset, and that is multiplied by the option price, whatever the premium, whatever the option price that he paid, minus the excess of the market price over the exercise price, the strike price. So from this example, so we can understand the exercise of this call option. Okay, when a call option in the money, the XYZ company bought call options giving it the right to buy 100 shares of NSM Corporation stock in 30 days at $100 per share. ABC company sold these options to XYZ company for $3 per share. On the day 30, NSM stock is trading at $105 on that day 30. So the market is good, higher price than the face value of the option price. So therefore, XYZ company, who is the buyer, the owner of that option now, exercise all of its options, since the options give XYZ the right to buy ABC stock at a better than market price. Because market price is $105, but he will get in for $100, which is option strike price. So XYZ and ABC's respective gains and losses on the transactions can be calculated as follows. So the buyer's gain will be that 100 call options. So at the rate of market price, which is 105, minus that face value, which is $100. So it becomes $5, and $5 per unit of that instrument, minus $3 premium he paid, okay, per share. So he has $2 gain for this 100 shares. So he get $200 gain. Same thing for seller, it will be the loss for that. So this is the idea. How do you calculate that? Buyer, holder, long positions and short position is calculated like this. So we understand better this by this graphical image, the call options. So if you think this is the when they equal market equal to the face value of that options, and if it is going beyond, so it is the seller's gain is getting and the buyer's gain is starting here, and seller's gain is that for the price of underlying things the seller's is loss and buyer is gain. But if the exercise price is in dollar up to 100 in the previous example that we saw, up to that the seller is in gain and buyer is at loss. When it is reaching the price is 103, so automatically the seller is losing but the buyer is gaining. Okay, so accordingly, so this is calculated. So similarly, now we understand the put options. The buyer's gain, that means the buyer's gain will be the mirror image of the seller's loss or vice versa. So the buyer, the holder of that put option will be in short position and seller writer, the buyer of that, the seller of that put option will be in long position. So this is the formula. And now example for in the money situation for put option. So same XYZ company bought put options giving the right to sell 100 shares of NSM Corporation stock in 30 days at $100 per share. ABC company sold these options to XYZ for 3 per share. On day 30, NSM stock is trading at $92. In the previous example, it was $105, but now price is less. And XYZ exercise all of its options because they had a put option. They are willing to sell at $100, so they will do it. So they will exercise that options. So therefore, the buyer's gain will be the buyer of that put option, meaning that they will be selling it. So that means the price of that face value is $100, market is only 92, so they are gaining $8 compared to market price, but their price of that option is 3, so they have $5 gain per share, which is multiplied by 100, so they have 500 shares. The put option holder, the buyer of that put option, is having $500 gain, and the seller of that, the writer of that put option, is losing that. See one more example for an out of the money put option, means it's not profitable, so the strike cannot be done. So on day 30, NSM stock is trading at $104 and XYZ's options are worthless because of that out of the money situation. Since having options to sell NSM at $100 gives XYZ no advantage over selling on the open market. XYZ and ABC's the writer respective gains and losses similarly for that calculation. So the buyer of that put option, because it is out of the money situation, he will lose it. So for 100 options, because he has $3, which is he is losing because he is not exercising that option, so there is no price difference here, but he is losing that $3, that the price that he paid, so there will be $300 loss only, meaning he is not exercising his option, but still he is losing that premium paid, so his loss is only $300. But the writer, what he will do, whatever that $300 he got it, that is the only gain he got it. So that is the gain. Okay. Same situation as it moves in the graphic, that the buyer's gain to the seller's loss and seller's gain to the buyer's loss. So now multiple choice questions. If a call option is out of the money, so we have just seen the definitions also. If a call option is out of the money, whether option A, it is not worth exercising, or the value of the underlying asset is less than the exercise price, or option C, the option no longer exists, or option D, it is not worth exercising and the value of the underlying asset is less than the exercise price. So almost option A and D is giving the same answer, but D is more clarity and it is more appropriate. It is the best answer because it is not worth exercising is the meaning of out of the money. But why it is because the value of the underlying asset is less than the exercise price. So that is the idea of that. So option D is correct. So put call parity theorem. So this is how that we have just seen also this theorem, and mathematically it can be depicting with this the value of put plus the value of underlying asset minus the value of call equal to the present value of exercise price. So this is the theorem formula that we use. Put call parity theorem mathematically depicts the combinations of investment strategies that can be devised using European options. That is those with a single exercise date. On that particular date, what is these options? So accordingly you can use it. The two sides of this equation represents combination with identical outcomes given identical exercise price for the put and the call and identical expiration dates. The combination of buying a put option, buying the underlying and selling a call option provides the same return as investing the present value of the exercise price at the risk-free rate. Knowledge of these relationships can help investors devise appropriate option strategies. So if you remember this formula, you can always calculate how the present value of exercise price can be there. You can compute on that. For example, in this formula, if you have only one missing value, you can arrive at that, given that. So that you can say, you can estimate what will be the value of put option if you got all other values here. Or you can guess what will be the value of call option by having all other values. So this put call parity formula is essential for that to answer many multiple choice questions also, and even in your business. Let's explain little further more on this put call parity. The buyer of a call may wish to hedge against the loss that he will incur if the market price of the underlying fails to rise sufficiently. Why do he invest on that call option? Because he will use it if the market is showing him a loss. So that he will cover by that. The buyer can do this by investing the present value of the exercise price in a safe investment. If the option is out of the money on the expiration date, the option holder has the return from his safe investment to make for the loss. So he will make that safe investment on that. The buyer of put option may wish to hedge against the loss that he will incur if the market price of the underlying fails to fall sufficiently. So if the price is not getting down, so he will be losing for that. So if it is up, because it's no use for him to use that put option. So the buyer can do this by buying the underlying at the same time as option. So what he will do, if he has a put option, he will have an underlying asset also, keep it ready for that. So that is the idea. If the option is out of the money on the expiration date, the option holder can simply sell the underlying asset and give going market price to make up for the loss. So instead of relying on the market, he will hold the actual underlying asset as a security for his against his put option, any loss if the situation come out of the money. So that is the idea. Here we are seeing at how do we value of a call option and value of a put option. So this table will give an idea of that instead of paragraph for reading. So it's highlighting the difference between this call option and put option and while valuing these options. So the buyer benefits from a low exercise price, so that he has a benefit on that. And the buyer of the put option benefit only when there is a high exercise price. Okay. Thus, an increase in the exercise price of an option result in a decrease in the value of a call option. And for the put option, an increase in the value of the put option. As the price of the underlying increases, if the underlying assets, the market value is increases, the exercise price is more and more of a bargain with each additional dollar in the price of the underlying. So as and when the price keep on increasing from the market, so the value of a call option will also increase, because the call option will also have the underlying price is increasing. So he will have that better in the call option, because he has the same fixed price already with his call option. So if he is selling the call option itself, because the underlying price is increasing, underlying assets of that options is increasing, so his call option price also will increase. But the value of a put option will decrease, because it's on the contrary, since there is no advantage in selling at a lower than market price. Okay, because market price is increasing. So as the price of the underlying increases, the exercise price is more and more of a bargain with each additional dollar in price of the underlying. So the value of call option will also increase, we saw, and the value of put option also will decrease. So this is the thing. If the option is exercised in a period of raising interest, so supposing if the interest rate is raising, the exercise price is paid in inflated dollars, making it more attractive for the option holder, because the interest rate is increasing, inflation is high, so the option price is better. The purchase of option is a form of down payment, as it is like buying the underlying on credit. So that means it is not buying actually the underlying asset, but buying like in credit, that in future I may buy, so at a fixed price. When the market is high, good, so he buy it at that price, at the striking date, at the exercise maturity date. So this results in the rise of the value of call option in the market. Okay, so for the put option, it will result in fall in the value of put option. This table shows now when the time until expiration, that means the more time that passes, the riskier any investment. If it is 1 month, 2 months, 3 months, the time is increasing because it is the market condition is unpredictable. So that is, if that time is increased in the term of an option, so it will result in an increase in the value of the call option, and in the put option it will be decreasing because the risk is more. So here is the table that students can understand easily for that. Increase in exercise price, so value of call option, whether it is decreasing or increasing. So this table will be useful for your getting an idea quickly in the examination, because the examination hall is not the time for you to think what if, so that you just take a photos, take a selfie on your eye. These things, okay. So value an option. So intrinsic value of an option. So how do you? It is, what is mean by intrinsic value? It is like kind of inherent value of an option. Okay, it is a value that natural value of the option is the difference between the spot price and strike price of the underlying asset. So what is the spot price on the market and what is the strike price of that? So then you get the intrinsic value of the call option as well as the put option. So the spot price minus the strike price is the intrinsic value of call option. And because you should understand that why spot price minus strike price, because only if the spot price is more than the strike price, then the call option is in the money. So that difference is the intrinsic value of that. Because if it is spot price is less than the strike price, it is out of the money, so no need to calculate the intrinsic value of that. Okay, because you will not need, you are not obligatory to exercise that option. So that's why this formula you should remember. And similarly for the put option, because it is the strike price should be better, then only he can go to the market in the, sell that option, use that option to put. Okay, so that will be in the money for him. So the spot price should be lesser than that. If the price should be down than the strike price, then only he will use that option. So that is why this formula. So time value of an option is the difference between its premium and its intrinsic value. That is, whatever premium that you are paying minus you take the spot price minus the strike price, you get that the time value of an option. So volatility of price of an underlying, how the fluctuation, the price of an asset can drop no lower than zero. It cannot be lower than zero. Thus, there is a natural limit to the potential downside loss for either party to an option transaction. On the upside, however, there is a much greater flexibility. Thus, parties to an option transaction will prefer volatility. So, if it is flexible, they will prefer that because it cannot be zero. Because when it is out of the money, they will not exercise that option. So, it cannot go beyond that level. See a CMA adapted question given as an example. An investor buys one ABC $60 call option for $3.50 paid as premium when the market price of ABC is $63. So what is the intrinsic value and time value of the option contract? So based on the earlier formula we calculated. So given the market price of the stock, which is 63, the call options exercise price is, that is given X60. So the option is in the money. It is definitely. So therefore it is in the money. So we can use that formula. So the spot price, which is $63 minus that $60, which is exercise price. So we get $3. So the time value, because you take the premium, the option price, which is 3.50, and you got that the intrinsic value, which is $3, you take 0.5, that is half dollar, is the time value. Another example, a company has recently purchased some stock of a competitor as part of a long-term plan to acquire a competitor. So he want to purchase some stock, but he is planning to acquire that entire company. Okay. However, it is somewhat concerned that the market price of this stock could decrease over the short term. So maybe he expect. So the company could hedge against the possible hedge, means they can go for some call option or put option. So they are hedging against the possible decline in the stock's market price. So to cover the risk of that market price can down, so he will be hedging. So what is the right option? Purchasing a call option on that stock, or purchasing a put option on that stock, or selling a put option on that stock, or obtaining a warrant option on that stock. So it is better to purchasing a put option on that stock. Why? Because if the price of the assets is feared to be declining in the future, because they want to buy that company also, so they are gradually, naturally, they are inclined to buy that stock, but they are afraid of that the price may come down. That's why they are hedging. So they are hedging for a put option. If the price will go down, so they can use that put option to sell it. So that is the idea. It can be hedged through having an option to sell it at a specified price. Which of the following is accessible only at the expiration date? So option A and D, we can ignore them because they may be an American option or European option. So the characteristics of American option and European option is important for us. So American option is exercisable at any time up to that expiration. So that is also wrong. But European option we have by definition is exercisable only at the expiration date. So that is the right choice. Another multiple choice question. It is a calculation. Just we have to do it. A company has purchased one share of QQ company common stock and one put option. It has also sold one call option. The options are written on one share of QQ company common stock and have the same maturity date and exercise price. So the exercise price is $40. So it is given already. It is the same as the share price also. Moreover, the options are exercisable only at the expiration date. So assume that the value of a share of QQ company common stock at the expiration date is either it can be $30 or it can be $45. So the difference in the net payoff on the portfolio because of a difference in the stock price at the maturity date is. So you have to calculate on what if that $30 is the price on the market or if it is 45. So then you can see the net payoff on that. So that is how you have to calculate. You take this into table. What if the stock price is 30 and what if the stock price is 45? So we know clearly that the put option will be worth if when the stock price is 30 because put option will gain at least $10 because the call option is worthless. Okay, so he will use the put option because actual stock value is $40, but now the underlying value is option value is $40, and the current market is $30. So you will exercise that put option so that he gain $10. But actually, you remember that this question says there are three things involved. One is that the company has purchased the share, one stock, common stock, actual stock. Another one, they purchased one put option and they sold one call option. So three things you have to remember. But all values are $40 only, face value. No talk about discount or premium on that. So just simple calculation for that. So first on the put option, they go for because it is in the money, so they go for that. So they gain $10. But what happened to the stock that they have? That value become 30 only. What they have on hand, that become 30 only. So that 30 plus this $10 that gain they have is $40 they have now as net payoff for the when the market is 30. But if the market is 45, they will not exercise put option because market is higher rate, but they will use the call option because not that they will use, but the buyer of that call option will use because they sold only call option. So the buyer of the call option will definitely use that because stock price is high. So therefore they get the loss because they have to give that. So they will get loss of $5. So that is that. But actually their stock value what they have will be 45, but this loss is $5 will be less, so that their value they come back to $40 only. Therefore it both come to zero value. So consequently the difference in the net payoff on the portfolio because of a difference in the stock price at the maturity date is zero only, both sides. With $30 or $45, so the net payoff is zero. So the portfolio has the same value of the maturity date regardless of the price of the stock. How much must the stock be worth at expiration in order for a call holder to break even if the exercise price is $60 and the call premium was $3? This is simply, we say that break even means there should be no loss, no gain. So it is very simple calculation. If we have exercise price 60 and the premium is 3, so total your value is 63. So $63 is the break even value. Okay, so that is the idea. A firm is planning to issue a callable bond with an 8% coupon rate and 10 years to maturity. A straight bond with a similar rate is priced at $1,000. So if the value of the issuer call option is estimated to be 50, what is the value of the callable bond? So if the price of the bond is priced at $1,000 and the call option, the issuer's call option is priced at 50, so naturally the difference being 1000 minus 50, which is 950. Because here you are talking about the price of that option bond, the callable bond, and the price of that and the cost of that bond which is given here. So you need not calculate about the interest rate and other things here in this question. It is just to confuse. Thank you. Praise be to God. எல்லா புகழும் இறைவனுக்கே. And let's see in our next lecture that will be covering forward contracts and futures contracts and swaps.